Welcome back to the Deep Dive.
Glad to be here.
So, today we're going to do something that feels, it feels a little bit counterintuitive given the current state of the crypto market right now.
Oh, absolutely.
Because if you look at the charts today, or really any day this week, it is just absolute chaos out there.
Yeah, the noise is deafening.
Exactly. We've got, meme coins doing 100x in an hour. We've got people leveraging their houses on animal pictures.
Which is terrifying.
It is. It's this giant wall of noise. And it's exciting, sure, in a sort of late night casino kind of way. But today, for you listening, we want to step away from the casino entirely.
It is definitely time for a detox. I think a lot of mature investors are looking for that.
They are. And to be honest, usually when we talk about things like infrastructure or settlement layers, people's eyes just glaze over.
It sounds like plumbing.
It does sound like plumbing. That sounds boring. But the sources we have on the desk today.
That massive stack of documents.
Right. This whole stack regarding Algorand's 2026 architecture, they tell a story that is actually pretty wild if you look under the hood.
Yeah, it really is a massive shift.
Because we are talking about a network that has been running for over 6 years, since 2019, with zero downtime.
Not a single second of outage.
Which, if we are being honest, is a statistic that stands in stark contrast to some of the other major players in this space.
Oh, without a doubt. We have seen other top-tier chains halt for hours.
Sometimes days.
Exactly. So 6 years of 100% uptime is a very heavy metric to ignore.
It is. But here is the skepticism I think a lot of you listening might have right now, and I certainly have it. If the tech is so incredibly good, why isn't it the only thing we talk about?
The quiet giant syndrome.
Yes. Why is it the quiet giant? So today's deep dive is really about answering that specific question.
And we have some great source material to do exactly that.
We do. We're going to unpack the 2025 guide to ALGO crypto staking and governance alongside the 2025 plus roadmap. And the central premise we are exploring is that while the rest of the market was out there chasing the latest hype cycle, Algorand was fundamentally rewriting its own engine.
A complete overhaul in 2025.
Right. To become something else entirely. Not a crypto casino, but a settlement layer for nations, for global supply chains.
Where the best part.
And this is the part I really want to drill into later. A settlement layer for artificial intelligence agents.
The agentic economy.
The agentic economy. It sounds completely like science fiction.
It does, but it is actually the most logical progression of the technology we've seen so far. The documents outline a shift that makes the chain almost unrecognizable from where it started.
Unrecognizable how?
Well, they moved from a governance model to a strict consensus model. They moved from a relay network to a fully peer-to-peer gossip network.
Right.
And they are deliberately positioning themselves as the economic rail for these AI agents.
Okay, before we get to the robots buying things from other robots, I think we need to talk about the money.
Always follow the money.
Because if you don't understand how the money flows, you just don't understand the chain. In 2025, there was this massive overhaul in how people actually get paid to support Algorand.
The big shift from governance rewards to staking rewards.
Exactly. Set the stage for us. What was the old world like?
So this is crucial context for you to understand if you are analyzing this network. For years, Algorand relied on a system called governance.
Right.
It was a very democratic, very community-focused system. If you held the native token, ALGO, you would commit it for a 3-month period.
Like a lockup.
Not a hard lockup where you couldn't touch it, but you were essentially making a soft promise not to sell it or move it below your committed balance.
Got it.
Then, during those 3 months, you had to vote on measures.
What kind of measure?
Things like marketing budgets, grant allocations to developers, decentralized finance incentives, that sort of thing. If you voted on all the measures and maintained your balance at the end of the quarter, you got a reward paid out in ALGO.
I mean, that sounds nice on paper. You get paid to be a good, active citizen of the network.
It is nice. It really is. But here's the problem, and our sources are actually quite candid about this. Voting on a marketing budget does not make the blockchain itself secure.
Right.
It engages the community, it gets people reading the forums. But strictly speaking, from a cryptographic computer science standpoint, having 100,000 people vote on a PDF document doesn't make the network harder to hack.
It is a process transaction.
Exactly. It doesn't add hash power or finalize blocks. It is just decision making.
So it was what, just security theater?
I wouldn't go quite that far. It was genuine governance, but the network reached a maturity point where it needed real security hardening at the base layer.
So they changed the incentives.
Yes. The 2025 pivot was to stop paying people just to be voters and start paying people to actually be guardians of the ledger. They shifted the rewards from the passive holder who just clicks yes on a website every 3 months to the active participant who runs a node and physically helps achieve consensus.
Okay, so let's get into the weeds of this consensus mechanism, because this is where the Algorand documentation claims to be fundamentally different from everyone else in the space.
The pure proof of stake model.
Right, pure proof of stake, or PPOS. Now, everyone who follows crypto knows regular proof of stake generally. Ethereum transitioned to it. Solana uses a version of it.
Most modern chains do.
But the sources we are looking at keep highlighting this specific no lockup feature as their unique selling point. Why is that such a big deal for the mature investor?
To understand why it matters so much, you have to look at the friction that exists in those other systems.
Okay, let's use Ethereum as the baseline.
Perfect. In Ethereum, if you want to stake your ETH and earn yield, you are essentially locking your capital into a smart contract.
Right, you set it away.
It is a bond. You are saying to the network, here is my money, hold it hostage so that I behave myself while I process transactions.
And if I want that money back?
There is an unbonding period. Depending on the network queue, that can be days, sometimes weeks. During that entire waiting period, your capital is dead.
You can't trade it, you can't use it as collateral.
You are totally liquidity constrained. Algorand's pure proof of stake is fundamentally different because there is absolutely no bond.
So where does the money go?
Nowhere. You hold your ALGO in your own wallet, your hardware ledger device, your mobile para-wallet, wherever you want.
It never leaves.
Never. You simply send a special zero-value transaction to the network that flags your account and says, I am online and my node is ready to participate.
But I still have the funds.
You have total control. You could spend that ALGO 5 seconds later to buy a coffee if you wanted to. The protocol simply checks your balance in real time, block by block, to see how much stake weight you have at that exact millisecond.
That sounds fantastic for the user, obviously. I retain custody and liquidity of my assets. But let me play devil's advocate for you here.
Please do.
If my money is not locked up and there is no hostage situation happening, what stops me from attacking the network? In Ethereum, the fear of slashing is what keeps people honest.
Right, the financial penalty.
Exactly. If I try to double spend or if I mess with the ledger, the network detects it and burns my staked money. Algorand proudly advertises no slashing. That sounds incredibly dangerous to me.
It does sound counterintuitive when you first hear it. How do you enforce accountability without a punishment mechanism?
Right.
The answer lies in the cryptography itself, specifically something called verifiable random functions, or VRF. This is the absolute heart of the Algorand engine.
VRF. Okay, break that down for us. Assume I don't have a computer science degree.
Okay, let's use a lottery analogy. In a traditional blockchain setup, or a traditional lottery, everyone buys a ticket, puts it in a giant glass bowl, and someone pulls the winning ticket out on a stage.
And everyone sees who won.
Exactly. Everyone sees the winner at the exact same time. The problem with that transparency in a blockchain is that if I am an attacker and I know that you are going to be the one to propose the next block,
I become a target.
you become a massive target. I can execute a distributed denial of service attack against your specific IP address. I can flood your computer with junk data so you physically cannot publish the block.
Which stalls the network.
Right. Because the leader is known in advance, the leader is vulnerable.
So how does VRF fix the glass bowl problem?
Algorand completely flips the mechanic. Instead of a public bowl where everyone watches the draw, the lottery happens secretly, inside your own computer.
Inside my node.
Yes. Every single account that is participating in consensus runs a tiny cryptographic calculation. Think of it like a digital lottery scratch-off ticket that only your computer can see.
Okay.
If you win, the math securely tells your machine, congratulations, you are the block proposer for this round.
But nobody else on the network knows I won.
Nobody knows until you actually announce it. You construct the block of transactions, you attach your winning cryptographic ticket to prove you actually won, and you broadcast the whole package to the network all at once.
So by the time the attacker realizes, oh, the host won this round,
the block is already propagated across the globe. It is entirely too late to attack you. Your job is already done.
that is incredibly clever. It is security through obscurity, but it's mathematically proven obscurity.
Precisely. And it's because of this exact mechanism that you do not need slashing.
because the attack vectors are closed off before they open.
Exactly. You see, in other chains, slashing is primarily there to punish people for going offline or trying to coordinate an attack by double signing. But in Algorand, if you go offline, or if your power goes out,
What happens?
you just don't run the scratch-off ticket. You don't win the lottery. You miss out on the block rewards for that period. That is the only penalty. You do not lose your principal investment.
Because the system just moves on to the next winner.
Right. The system relies on the statistical fact that with tens of thousands of nodes running, someone who is honest and online will win the lottery in that fraction of a second.
So the stick isn't a financial penalty. The stick is just FOMO, fear of missing out on the yield.
Basically, yes. And for you as an investor, this shifts the risk profile dramatically.
Also,
Think about it. If you are an institutional fund manager, or even just a regular person staking your life savings, the idea that a software bug or a server misconfiguration or a localized internet outage could permanently burn 5% of your assets is absolutely terrifying.
I wouldn't sleep.
Nobody would. That is the harsh reality on slash-heavy networks. Algorand removes that existential risk completely. You might miss a few algo in payments if your router dies, but your underlying asset is perfectly safe.
Okay, that distinction between governance and real consensus makes total sense now. But looking at the 2025 roadmap, there is a very specific number that jumped out at me regarding these rewards.
The threshold.
The 30,000 algo threshold. What is that about?
Right, so this is the new barrier to entry for the block proposer role.
So if I'm listening to this and I have 50 algo in my wallet, am I just not securing the network anymore?
Well, you can legally participate in consensus with just one ALGO. The protocol allows it. But to be the designated proposer, the node that actually bundles the transactions, builds the block, and gets the big reward, you need that 30,000 algo minimum stake.
Why set a minimum at all?
It comes down to probability and network efficiency. With a really small stake, say 50 algo, your statistical chance of winning that secret VRF lotteries is so incredibly low, it might happen once every decade.
Right, the more tickets you buy, the better your odds.
Exactly. The 30,000 threshold is simply the mathematical point where the economics start to actually make sense for someone to leave a dedicated machine running 24/7. Under that, the electricity costs might outweigh the rare block reward.
Wait, but if I get the big reward for proposing, what is the reward?
Under the new 2025 structure, the proposer gets a flat 10 ALGO per block, plus 50% of all the transaction fees in that block.
Okay, but 30,000 algo is not exactly pocket change for everyone. Does this create a rich get richer scenario? If I'm a small holder with a couple of hundred algo, am I just completely priced out of these new consensus rewards?
Not at all. And the ecosystem adapted to this very quickly. The sources heavily detail the rise of liquid staking and pooling.
Like Lido on Ethereum.
Very similar concept. Platforms emerged, Folks, Finance, Tinyman, and dedicated node pools like Velar and Nodely.
How do those work in practice for the retail user?
It functions like a cooperative.
Right.
You take your 500 algo and you deposit it into a smart contract pool alongside 1,000 other smaller holders.
Aggregating the stake.
Right. The pool easily hits the 30,000 threshold, runs a highly optimized node, consistently wins the block proposer rewards, and then automatically distributes those earnings back to you pro rata based on your deposit.
So the little guy still gets the exact same yield percentage as the big whale, just through a proxy.
Exactly. It democratizes the yield without clogging up the network with thousands of micronodes that rarely ever win.
Okay, so the economic engine has totally shifted. We moved from paying people to vote on PDFs to paying people to be active security guards. And the risk of being a guard is incredibly low because there is no slashing. I think we have a solid grasp on the money side.
The incentives are definitely aligned now.
But let's talk about the physical infrastructure.
Yeah.
Because at the exact same time they changed the monetary policy in 2025, they fundamentally changed the plumbing of the network itself.
Gossip network.
Yes, section 2 of our deep dive, the gossip network, which, side note, I just love that name. It sounds like high school drama.
It really does. But it's a very serious computer science concept. This is the peer-to-peer upgrade that went fully live in December 2025.
Right. But technically speaking, why was this massive upgrade even necessary? Because looking at the historical data, Algorand was already incredibly fast before 2025.
It was extremely fast, but it had a structural centralization bottleneck that critics rightly pointed out. Historically, before this upgrade, the network relied on something called relay nodes.
What were those?
Think of them as massive enterprise-grade servers, high bandwidth, massive solid-state storage. They acted like the central backbone of the internet. All the smaller participating nodes routed their transaction traffic through these massive relays.
And who is running these relay nodes?
That was exactly the issue. It was a permission list.
Meaning not just anyone could do it.
Right. It was mostly early backers of the project, major universities, and the Algorand Foundation itself. You couldn't just wake up one morning, buy a server, and decide to run a relay node. You had to physically be approved and put on the official list.
Which is pretty much the antithesis of the whole crypto ethos, right? It sounds like they were saying, trust us, we have really good servers.
That is exactly what it was, and it was a totally valid criticism from the broader blockchain community. Because if a hostile government or a really determined attacker wanted to censor the Algorand network back then, they had a static list of IP addresses they could target.
Oh, wow.
Right. They could say, shut down these 100 specific relay servers and the entire network communication halts.
It's a single point of failure, or at least a highly concentrated point of failure.
Exactly. The peer-to-peer upgrade completely dismantled that vulnerability.
So how does the gossip network actually fix it? Walk me through the mechanics of gossip.
Okay, imagine you are in a crowded classroom. In the old system, with the relay nodes, if you wanted to pass a note to your friend across the room, you had to hand it to the teacher standing at the front.
And the teacher would walk it over.
Right. The teacher controls all the flow of information. If the teacher gets sick and leaves, or if the teacher decides they don't like the contents of your note, the communication completely stops.
The teacher is the bottleneck.
The gossip network is what happens when the teacher leaves the room entirely. Now, if you want to pass a message, you just whisper it to the person sitting directly next to you. You say, hey, I just saw this transaction.
And then what?
That person immediately turns and whispers it to 3 of their neighbors. And those 3 whisper to 3 more.
Exponential spread.
Exactly. The information propagates across the room, or in this case, across the globe, at an exponential rate. It travels through a decentralized mesh of what the developers call permissionless repeaters.
Permissionless being the key word there.
Yes. You, me, anyone listening to this right now can spin up a repeater node. You do not need permission. You don't need to sign a contract or get put on a list.
Which makes censorship practically impossible.
It makes the network incredibly resilient. A government cannot shut it down because they literally do not know who is running the routing infrastructure at any given moment. It is like trying to stop a rumor in a high school. You cannot kill the source because everyone is simultaneously the source.
That makes perfect sense for decentralization. But here is my question regarding performance. Usually in technology, when you move from a few centralized, highly optimized enterprise servers to a messy, decentralized, peer-to-peer mesh, things get a lot slower.
That is the standard trade-off, yes.
So did the network slow down when they turned the teachers back?
That is actually the engineering miracle of this 2025 update. The block times didn't slow down, they actually dropped.
It got faster.
They got faster. They went from roughly 3.3 seconds per block down to 2.9 seconds.
Wow.
They optimized the underlying gossip protocol so efficiently that the decentralized permissionless mesh is functionally faster than the old expensive relay system.
2.9 seconds. I really want to pause on that specific number for a moment, because in the legacy world of Visa or MasterCard, 2.9 seconds is just normal. You tap your card, you wait 3 seconds, it approves.
Right. We expect that as consumers.
But in the crypto world, we are deeply conditioned to waiting. Bitcoin takes, 10 minutes just to produce a single block?
It produces a block every 10 minutes,
No.
Sure. But you cannot safely trust just one block on Bitcoin. The standard practice for a large transaction is to wait for at least 6 block confirmations to be safe from a reorganization.
So that is a full hour of waiting.
At minimum.
And what about Ethereum? That's the main smart contract platform.
Ethereum is much faster than Bitcoin. Blocks are produced roughly every 12 seconds. But again, you have to wait for the network to reach what they call finalization. Depending on network congestion, that finality can take anywhere from 12 to 15 minutes.
And this brings us directly to the concept of instant finality. Reading through these sources, they hammer this point home repeatedly. Instant finality.
Yeah.
Why is this specific feature the hill that Algorand is willing to die on?
Because of the real world, that is the simple answer. If you are standing at a counter buying a cup of coffee, or if you are a supply chain tracking a shipping container, you cannot wait 15 minutes for the blockchain to decide if your money or your data is actually good.
You'd be standing at the register looking like an idiot.
Right. You need that instantaneous beep-approved experience. Algorand offers exactly that. When a block is written to the chain, which happens every 2.9 seconds, it is permanently final.
There is no waiting for 6 confirmations.
None. There is no probabilistic waiting period. There is no concept of an uncle block or a chain reorganization. It is mathematically impossible for the Algorand blockchain to fork.
Now, impossible is a very strong word to use in computer science.
In this specific cryptographic context, it is completely accurate. The protocol is inherently designed such that two different blocks cannot possibly be certified by the network in the same round.
Okay.
So the moment your payment goes through and is included in that 2.9-second block, it is as permanent and irreversible as a Bitcoin transaction that has been sitting on the ledger for an entire year.
That is profound.
That level of absolute certainty is what real-world businesses demand before they will adopt a technology. Banks do not do probabilities.
Which is a perfect segue. Because speaking of businesses, let's pivot to section 3 of the outline. We had spent all this time building this metaphorical Ferrari engine, right?
Pure proof of stake, 2.9-second finality, a permissionless gossip network.
Exactly. It is secure, it is incredibly fast, it is decentralized. But a Ferrari is completely useless if it just sits in the garage looking pretty.
You have to drive it.
Who is actually driving this thing? Because the real-world utility section of the 2025 roadmap is essentially a massive catalog of answering the question, can a blockchain actually do that?
And this is where the supposedly boring infrastructure stuff becomes truly revolutionary. The case studies in this report are not about flipping digital art or trading speculative tokens. They are addressing fundamental human and economic needs.
The one that struck me immediately, and I think we really need to spend some time on this to ground the technology, is HezPay in Afghanistan.
It is arguably one of the most impactful real-world blockchain implementations currently in existence.
Set the scene for us there. Why Afghanistan?
Think about the geopolitical situation in Afghanistan over the last few years. After the massive political changes and the regime shift, the traditional banking system essentially froze overnight.
Because of international sanctions.
Yes. Heavy international sanctions meant that huge global banks simply could not interact with Afghan local banks anymore. The SWIFT network cut them off completely.
So you have these massive humanitarian aid organizations, the World Food Program, the UN, various NGOs. They are sitting on millions of dollars of desperately needed aid.
And you have people in Kabul who are literally starving.
But there is no financial wire to connect the two. The traditional rail is broken.
Completely severed.
Yeah.
And even if you could somehow fly pallets of physical cash into the country, which some organizations did try for a while, it is incredibly dangerous.
It gets intercepted.
It gets stolen, there's massive local corruption, the logistics are a nightmare. The critical last mile of aid delivery was completely broken.
Enter Algorand.
Enter HezPay, which is a digital payment solution built entirely on the Algorand blockchain.
How does it work for the person on the ground?
It is brilliantly simple. The International Aid Organization sends digital dollar stablecoins directly to a recipient's registered phone number.
So the recipient doesn't need to go open a bank account.
They couldn't even if they wanted to. They don't need a bank. They don't even need to understand what crypto or a blockchain is. They just get an SMS notification on their basic smartphone saying funds have arrived.
And how do they buy food with a text message?
They walk down to a local participating merchant, a pharmacy, a grocery store, a baker. They open the HezPay app, they scan a QR code on the merchant's counter, and they instantly transfer the digital dollars for their goods or for physical local currency.
And on the back end, this entirely seamless transaction is settling on the public blockchain.
Yes, but the user experience completely abstracts it away. The user never sees a hash like block 49201. They just see payment received in green text.
And the merchant accepts it because
of that instant finality we just talked about. The merchant knows with absolute mathematical certainty that the money is in their account within 2.9 seconds. They don't have to worry about a credit card chargeback 30 days later.
And what about the cost? We mentioned fees earlier.
This is the crucial part. If an NGO tried to send $50 of aid using the Bitcoin network, the transaction fee might be $10 or $15 during peak congestion.
Which is unacceptable when you're trying to feed people.
It defeats the purpose. On Algorand, that exact same transaction costs a fraction of a penny, roughly $0.001. That massive reduction in overhead literally translates to more food on the table for families.
That is the moral case for the tech. It is technology stepping in to fill a vacuum where traditional finance completely failed the most vulnerable people.
It provides dignity, and it provides total transparency for the donors who want to verify where their funds actually went.
But there is also the high finance regulatory case. Moving from Kabul to Frankfurt, we saw repeated mentions of a company called Quantos and something called MiCA compliance in Europe.
Yes. This feels like the exact opposite end of the spectrum.
It really does. Hyper-regulated, bureaucratic European institutional finance. Walk us through what is happening there.
Okay, so MiCA stands for the Markets in Crypto Assets Regulation. It is the European Union's massive, comprehensive regulatory framework for digital assets that took full effect recently.
And I imagine it is strict.
It is extremely strict. For a very long time, traditional banks in Europe were absolutely terrified of touching stablecoins because they simply didn't know what the rules were. They didn't want to get fined. MiCA finally set the concrete rules.
And Quantos is issuing tokens based on these rules.
Correct. Quantos launched 2 stablecoins on Algorand, URQ, which is pegged to the euro, and USDQ pegged to the dollar.
So how are these different from, say, Tether?
These are fully regulated, transparently fiat-backed tokens authorized as e-money tokens under European law. This isn't some experimental algorithmic stablecoin like Terra Luna that might arbitrarily spiral to zero overnight.
This is actual digital cash.
This is digital cash that has the explicit blessing of the European regulators. The fact that a regulated entity chose Algorand as the underlying infrastructure for this speaks massive volumes about the finality and the enterprise-grade security we discussed.
Because central banks do not like probabilistic security.
They despise it. They need absolute guarantees. Algorand provides that.
And it isn't just back-end banking. The sources mention the Para-Debit MasterCard, which seems like the ultimate bridge between this complex Web3 world and my local grocery store.
That is exactly what it is. It allows you to hold your USDC stablecoins natively in your non-custodial Algorand wallet, but spend them anywhere in the world that accepts a standard MasterCard.
So the blockchain effectively becomes my checking account.
Without the monthly maintenance fees, yes.
Okay, so we have humanitarian aid, we have European institutional banking, we have consumer payments. But I want to touch on a non-financial use case. World chess.
The Intermezzo project.
Right. What does a board game have to do with a decentralized ledger?
It is about immutable records. World chess is moving player points, match histories, and official chess ratings entirely on-chain for over 1 million players globally.
Why not just use an Amazon database?
Because a centralized database can be hacked, altered, or manipulated by an admin, in professional chess, your rating is your livelihood. By placing that data on Algorand, World Chess creates a permanent, tamper-proof, globally verifiable record of every match outcome. It proves the blockchain is highly effective for data integrity, not just moving money.
That is fascinating. Now, the last major utility category the roadmap emphasizes is sustainability and supply chain. We hear the phrase supply chain on blockchain thrown around in tech presentations constantly. Is it actually happening, or is it just a slick marketing press release?
In this specific case, it is absolutely happening, and it is happening with major global players. The documents highlight a company called Finboot.
Who are they working with?
They are working with massive European energy giants like Repsol and Cepsa.
What exact problem are they trying to solve with the blockchain?
They are trying to solve the problem of greenwashing.
Proving that your supposedly green product is actually green.
Exactly. If Repsol sells a massive batch of what they claim is low-carbon aviation biofuel to an airline, how does the airline or the regulator know it isn't just regular dirty jet fuel mixed in?
Currently, I assume it's just a lot of paper certificates and blind trust.
It is entirely paper trails and PDFs, which are easily falsified. Finboot uses the Algorand blockchain to create a verifiable digital passport for the fuel itself. Every single processing step, every refinement facility, every transportation handoff is logged immutably on-chain.
So anyone can trace the barrel of fuel back to its origin.
Because the blockchain cannot be edited or deleted, it creates a mathematically verifiable chain of custody.
But again, bringing it back to economics, the cost matters immensely here. You cannot spend a $50 Ethereum gas fee to track every single barrel of oil in a refinery.
You can't. High-frequency industrial data logging fundamentally requires a sub-cent, low-cost chain.
And it also requires a green chain. If you are an energy company trying to lower your carbon footprint, you can't be using a system that burns coal.
Right. The sources highlight this repeatedly. Algorand is a carbon negative network.
Meaning it offsets more than it uses.
Yes. Because pure proof of stake is so computationally lightweight, remember, it can run on a standard mid-range desktop computer. Its actual electricity consumption is negligible compared to proof of work chains. It perfectly aligns with massive corporate ESG goals. You also see this with projects like Planet Watch putting air quality sensors on chain and Eureka verifying carbon credits down to the individual household level.
It really seems like the overarching strategy here is just quiet competence.
That's a great way to phrase it.
Just put your head down and work. be incredibly cheap, be blindingly fast, be legally compliant.
And let the utility speak for itself.
But I want to dramatically shift gears here.
Yep.
Because we are about to move into something that is decidedly not quiet. It is the loudest buzzword of the century right now.
AI.
Artificial intelligence. Section 4 of our outline is titled The Agentic Future. And frankly, this is the part of the deep dive where I really need you to walk me through it slowly, because my initial reaction is that it sounds like total tech bro hype.
I completely understand that reaction. It sounds like hype. But if you look at the trajectory of technology, it is actually a logical, unavoidable necessity. We are rapidly entering the era of agentic commerce.
Okay, let's establish a baseline. Define agentic commerce for the listener.
Sure. Up until right now, the internet as we know it has been a paradigm of humans talking to humans or humans manually interacting with machines.
I go to Amazon, I search for a book, I physically click the buy button.
Exactly. You are the active participant. Agentic commerce is a paradigm shift where autonomous machines talk directly to other autonomous machines. It is an AI agent independently interacting with another AI agent to negotiate, execute, and settle a complex task without a human ever pushing a button.
That is abstract. Give me a highly concrete scenario of how this actually looks in 2026.
Okay. Imagine you are running a small startup. You decide you need a new corporate logo. Today, the human way is you go to a site like Fiverr, you search for a designer, you haggle over the price, you pay them with your credit card, and you wait 3 days for an email.
Right. Standard freelance interaction.
In the very near future, under agentic commerce, you don't do any of that. You simply tell your personal business agent, AI, hey, I need a new logo. Here's our brand color guide. Go get it done.
And the AI just goes.
Your agent independently goes out into a digital marketplace populated by thousands of other AI agents, specifically design agents. It finds one, it negotiates a price in milliseconds, it securely transmits the brand guide, it automatically reviews the drafted image for errors, it pays the design agent, and it delivers the final image to your desktop folder.
All while I'm asleep.
All in 30 seconds while you're getting coffee.
Okay, so the robots are doing the freelance hustle. That is impressive AI. But where does the blockchain actually come into this? Why can't these smart AI agents just use Stripe or wire money through PayPal like we do?
This is the crux of the whole concept. Let me ask you this. Have you ever tried to go online and open a business PayPal account for a piece of Python software?
I can't say that I've ever tried that.
You can't do it. The system rejects it. To open a bank account or a payment gateway, you fundamentally need a driver's license. You need a verified utility bill. You need a social security number.
You need a biological heartbeat.
Exactly. The legacy banking system is exclusively built for biological humans and legally registered corporate entities. AI agents are neither of those things. They are just floating lines of code.
So the AI is completely unbanked.
Precisely. They are hyper-intelligent but financially castrated. They have no way to hold or transfer value autonomously, but on a public blockchain.
Oh.
Right. A wallet address on Algorand is nothing but a cryptographic key pair. You do not need a bank manager's permission to generate one. You don't need a passport.
An AI agent can literally just generate a wallet address in a millisecond.
It can generate a wallet, it can hold funds in USDC or ALGO, and it can programmatically sign and execute transactions completely natively. The blockchain literally is the missing banking layer for autonomous code.
That makes incredible sense when you frame it like that. But again, to play the skeptic, why Algorand specifically? Why wouldn't these intelligent AI agents just use the big network like Ethereum or a high-throughput chain like Solana?
It completely comes down to the economic nature of how AI transactions operate. These agents operate at the speed of silicon, not the speed of human thought. If two agents are negotiating micro-access to a specific weather data set or renting GPU server time for a single millisecond, they might execute 10,000 individual microtransactions in an hour.
And if they have to pay a $5 gas fee on Ethereum for every single one of those,
the entire economic model instantly collapses. You cannot mathematically pay a $5 processing fee to transfer 5 cents of computational value.
Right.
And you cannot afford to wait 12 minutes for a payment to clear finality if the server rental period you bought is only 10 seconds long.
It requires extreme efficiency.
Agents demand instant finality and highly predictable microscopic fees. Algorand's core architecture, that 2.9-second absolute finality and the $0.001 fee we keep coming back to, is perfectly, almost unnaturally optimized for this exact type of high-volume, low-value machine commerce.
The sources mention specific initiatives for this. Project X402 and the Google Agent Payments Protocol.
Yes, the AP2 integration. Algorand is actively building the software toolkits that allow developers to easily plug their AI agents directly into this payment rail.
So the overarching bet that Algorand is making is that eventually the sheer number of financial transactions initiated by robots will vastly outnumber the transactions initiated by human beings.
I think that is an absolute certainty at this point. Humans sleep.
Yeah.
Humans hesitate. Humans take the weekend off. AI agents will be transacting 24 hours a day, 7 days a week at speeds we literally cannot comprehend.
And if Algorand can capture even a tiny fraction of that automated rail,
The transaction volume would be astronomically larger than anything we see today.
and this seamlessly connects to the major developer updates in the 2025 roadmap, right? Section 4 also heavily focuses on AlgoKit 4.0, specifically the move to native Python.
Yes. This is the strategic key that unlocks the whole agentic vision. For years, if you wanted to build a smart contract on Algorand, you had to learn a highly specialized language called TEAL, Transaction Execution Approval Language.
I've looked at Teal.
Yep.
It is dense.
It is incredibly dense. It reads like low-level machine assembly code.
Not exactly user-friendly for a weekend developer.
Not at all. Or you had to use very specific niche SDKs. It created a massive friction barrier. Now, with the release of AlgoKit 4.0, you can write fully secure native smart contracts entirely in Python or TypeScript.
Why does transitioning to Python matter so much more than supporting, say, Rust or Solidity?
It is a pure numbers game. There are maybe globally a few 100,000 developers who know Rust or Solidity well enough to write a smart contract that won't get hacked.
It's a small talent pool.
Exactly. But there are roughly 10 to 15 million Python developers in the world. Python is the default language of data science. It is the core language of all AI development, and it is the language taught to almost every beginner in computer science.
So by natively supporting Python, Algorand just expanded their potential workforce by 50 times overnight.
Exactly. They removed the language barrier entirely. And this directly brings us to a concept mentioned in the roadmap called vibe coding.
I saw that term in the notes, vibe coding. Please, you have to tell me we aren't actually adopting that as a serious industry term.
Look, it is definitely a bit of a Gen Z marketing buzzword, but the underlying concept is incredibly real and powerful. Vibe coding refers to using large language models to write your software architecture for you.
Like ChatGPT or Claude.
Right. And because Python is the single most popular programming language on the internet, these AI models are exceptionally good at writing Python. They have ingested billions of lines of it. They understand it flawlessly.
So what you were saying is, I can just open a prompt window and tell the AI, hey, write me an Algorand smart contract that automatically pays out $10 when the temperature data in London hits 80 degrees. And because the target language is just regular Python, the AI can actually generate the perfect deployable code.
Yes, in seconds. The barrier to entry for building a Web3 application just dropped from needing to hire a senior blockchain engineer for $200,000 a year to just being a guy with a decent idea and an AI prompter.
It radically democratizes the creation of these decentralized applications.
That is exactly the goal.
That is a potent combination. You have Python making it easy for both humans and AI models to write the code rapidly, and you have a subcent instant network for the autonomous agents to execute that code affordably.
The synergy is very deliberately engineered.
But, and there was always a very large, but when we do these deep dives, none of this incredible architecture matters if the entire cryptographic foundation gets cracked open in 10 years.
The existential threat.
Right. We have to address the elephant in the room that is detailed in Section 5, the quantum threat.
This is the exact scenario that keeps global cryptographers awake at night.
We hear this headline constantly in the tech press. Quantum computers will break Bitcoin. Quantum computing will destroy crypto. Is this a real, tangible threat, or is it just the Y2K panic of our generation?
It is a very real, mathematically proving threat. It is just physics. The standard encryption that currently secures your online bank account, your private text messages, and yes, your Bitcoin or Ethereum wallet, primarily relies on specific math problems being exceptionally hard to solve.
Like elliptic curve cryptography.
Yes, ECDSA, factoring massive prime numbers. For a classical supercomputer, trying to guess your private key by brute forcing that math would take longer than the current lifespan of the universe.
But we feel perfectly safe.
But a sufficiently powerful quantum computer does not guess sequentially. It uses quantum mechanics to evaluate vast numbers of possibilities simultaneously. For a quantum computer running a specific process called Shor's algorithm, cracking that math is almost trivial.
So once a quantum computer with enough stable qubits is actually built and turned on in a lab,
It could theoretically derive your secret private key just by looking at your public wallet address on the blockchain. And if an attacker possesses your private key, they completely own your money. They own your identity.
the entire system goes to zero.
Instantly.
So if I am a European government or a massive central bank issuing digital euros on a blockchain infrastructure today, and my strategic plan is to use this financial system for the next 20 or 30 years, I absolutely need to know that the vault won't be easily blown wide open by a quantum computer in 2035.
Correct. Enterprise adoption demands decades of forward-looking security. And this is an area where the roadmap shows Algorand is arguably years ahead of the curve. The 2025 documents detail the deep integration of something called Falcon keys.
Falcon keys, what are those?
Falcon is a highly specific advanced cryptographic signature scheme. It has been rigorously tested and officially selected by NIST, the United States National Institute of Standards and Technology, as a standardized post-quantum cryptographic algorithm.
Meaning it is math that even a theoretical quantum computer finds impossible to crack.
Yes. It relies on complex, lattice-based cryptography instead of prime factorization. It is quantum resistant.
And Algorand is already deploying this technology natively.
They are actively implementing it at the base layer right now. Their state proofs, which are these incredibly compact, cryptographically secure summaries of the entire blockchain's history, are already fully quantum secure.
That is impressive foresight.
They are effectively upgrading the massive titanium locks in the global vault before the masterful thief has even been born.
That's a really great analogy. It is the ultimate insurance policy.
It is, and for the mature listener we are speaking to, the institutional decision maker, the fund manager, this is a critical box that simply must be checked on the due diligence form. You cannot responsibly build critical national infrastructure or put digital identity on a foundation that might mathematically shatter in a decade.
Speaking of institutional confidence and due diligence, there is one final piece of the 2025-2026 roadmap that really jumped out at me, and it is entirely geographic.
The foundation's relocation.
Right. The Algorand Foundation is officially moving its board of directors and its primary operational presence back to the United States in 2026.
That is a very bold, highly specific market signal.
Because for the last few years, the entire trend was the exact opposite. Everyone was fleeing the U.S. market. We constantly heard about regulatory uncertainty, harsh SEC enforcement actions, a hostile political climate.
Right, the brain drain. Major projects were packing up and moving to Dubai or Singapore or setting up foundations in Switzerland.
So moving the center of gravity back into the United States right now says what?
It says one very clear thing to the market. We are compliant. It says we are not hiding offshore. We are not afraid of the regulatory scrutiny. In fact, we actively want to sit at the table and work directly with the regulators to shape the future.
It is a massive bet that the U.S. market, which, despite the friction, is still by far the deepest pool of capital and institutional talent in the world, is finally ready to open up and provide regulatory clarity.
Exactly. If your ultimate goal is to become the underlying settlement layer for the S&P 500 or to power the back end of major Wall Street banks, you have to physically be in New York. You have to be in the room where it happens. Algorand is strategically positioning itself to be the responsible adult in the room when traditional finance finally decides to move everything on-chain.
Okay, we have covered an immense amount of ground today. Let's try to tie all these complex threads together for the listener.
We definitely covered the whole architecture.
We started by asking a deeply skeptical question. Why should anyone care about the quiet giant when the rest of the market is screaming? We looked at the fundamental engine overhaul, the shift from paying people to vote in governance to strictly paying for consensus through staking.
The implementation of that brilliant no-slashing security model.
All right. Then we looked at the physical plumbing, the transition away from permission relays to a fully decentralized P2P gossip network that makes it virtually uncensorable.
While actually increasing the speed to 2.9 seconds.
We saw how that speed enables actual real-world utility, providing humanitarian aid through HesaPay in Afghanistan and enabling MiCA-compliant stablecoins in Europe. We geeked out on the unlock of Python with AlgoKit 4.0 and the coming wave of autonomous AI agents.
And we secured all of it with post-quantum cryptography.
It really is a massive, comprehensive architecture.
It is entirely focused on the long game.
So for the listener who has been patiently sitting on the sidelines, or maybe someone who holds some crypto but mostly just watches the price charts go up and down, what is the final synthesis here? How should they actually view a project like this in 2026?
I think the biggest takeaway is that there is a massive structural divergence happening right now in the crypto space. On one path, you have the attention economy.
This is a casino.
Right, the casino. It is driven by memes, celebrity coin launches, and extreme volatility. It's a game. It is player versus player.
And what's the other path?
On the other path, you have the infrastructure economy. This is the highly complex, decidedly unglamorous work of building the underlying plumbing for the future of finance. Algorand is betting everything on being the best plumbing.
And plumbing, as we said, is just not sexy.
It isn't. You never invite your friends over to look at the pipes in your walls. You don't tweet aggressively about your municipal water pressure. But when the pipes burst and flood your house, it is suddenly the only thing in the world that matters.
That is incredibly true.
And if you want to build a towering skyscraper, or in this case, a new automated global economy, you absolutely have to start with an unbreakable foundation and perfect plumbing.
And Algorand is offering that foundation. Extreme predictability, instant finality, zero historical downtime, and strict regulatory compliance.
Exactly. In the world of high-level investing, boring and predictable often ends up being the most aggressively profitable strategy over a 10-year time horizon. If you truly believe that the future of finance is automated, instantly settled, and totally borderless, you don't need a noisy hype machine. You need a highly engineered machine that just works 100% of the time.
And that leads directly to the final provocative thought I really want to leave you listening with today. Think back to what we discussed in Section 4, those AI agents.
The autonomous robots transacting in the background.
Right. Those software agents are the ultimate rational actors. They do not have human emotions. They do not care about community vibes on a Discord server.
They definitely don't have Twitter accounts to argue about which coin is better.
Exactly. They care strictly about mathematical efficiency. They care that the transaction fee is exactly $0.001, and they care that the cryptographic settlement is permanent in 2.9 seconds.
They will inevitably choose the path of absolute least resistance.
Yes. So if the future of the global economy is going to be dominated by these automated, non-human users, well, won't they just inevitably default to the most brutally efficient rail available?
Logically, they will have no other choice. Their programming will demand it.
So the real question you have to ask yourself is this. If the future massive user base of Web3 isn't actually human, does the blockchain that powers it need to be exciting and loud? Or does it just need to be the absolute best possible plumbing? The sources we read today suggest Algorand is betting the entire house on the latter. And if they are right about this agentic future, the current silence of this quiet giant might just be the sound of it methodically taking over the entire back end of the internet.
That is a very powerful and very realistic thought to end on.
Thank you so much for diving into the architecture with us today. We will catch you on the next deep dive.